Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. This is Dean Worley with the New Home Insights podcast. Today, we have not one, but two top leaders at one of the best new home builders in the country. And I looked it up by volume last year, the 16th largest new home builder in the country in 2024. Today, we have Jay Brown and Chris Weekley from David Weekley Homes. How you guys doing?
We're great. Thanks for having us.
Doing well. Thanks for having us, Dean.
I'm glad we're here. So I love to have these choose. We can get some witty repartee when we have a couple of different folks on. So let's have fun. I'll set it up and then I'll have you guys just do a quick little self intro. But Jay, you're the CEO as of late last year at David Weekley Homes. Chris, you are the president and vice chairman at David Weekley Homes. So let's start with you, Chris. Maybe just give us a little brief intro, and then we'll get to it. We'll talk. By the way, listeners, we're going to talk about kind of the David Weekley story, then kind of how they strategize to grow into a major home builder like they are today, and then we'll look forward at the market and how they see strategy, how they see markets performing. But first, let's get to know Chris and Jay. Chris,
perfect. Well, thanks again for having us, Dean. We're so blessed and honored to be here. So, Chris Weekley, need to start off. Yes, my dad is David. Yes, I kind of grew up around this business. That's kind of the first question everybody asks. I've been at Weekley Homes for 18 years, started off as a builder, did some time in warranty and sales and various operational positions, and have been, at HST, kind of our main office here for 9 years. So blessed to be here. Home building's been around our family for a long time. And so this was not part of my life plan. There was no secret plan that I was going to come work with the company. We can get into that more depth later, but just blessed and honored to be here, and so grateful for a great team and great leader like Jay to be able to sit alongside and work together as a team to make this company the best we can be.
Do you ever mess with people and say, no, total coincidence, the last name just happened?
So funny story. We actually have a sales consultant in Houston named Eric Weekley. And it's spelled a different way. It's L-Y versus L-E-Y. Okay. So he's a good spiel about that. But no, there's another Weekley in the company besides Chris and David.
So he would pretend that he was the black sheep of the family. Jay, give us a little, tell us your kind of 30,000 foot level, how your start and how you came to David Weekley.
Sure. I've been here for just over a year now, and came June of last year. And it's been a great first year on the job. I was on the board for about 7 years prior to that. And prior to coming to David Weekley Homes, I didn't have any experience in the home building industry other than being on the board. I had been a part of a telecom company, a large public company based here in Texas. I had been the CEO there for 8 years. Prior to that, 8 years as CFO. We had grown that business basically from startup to a large public. So it's been fun to be in a new industry and to get to know the team and the folks here. And it's been a really good first year.
Yeah, that's a heck of a challenge too, isn't it? I mean, you had some familiarity with those 7 years on the board, but still the nuts and bolts. It has, I imagine, am I right? Has it been?
Yeah, it's very different being on the board than it is operationally. The level of detail.
Yeah.
I had a business that performs as well as our business has for a long period of time doesn't happen without great operators. But when you sit on the board, you don't really get to see that day to day in the same way that you do when you're sitting in an operating seat. And so the last year has been confirming in terms of what I saw on the board level, the results that were delivered, but to see how the team does that and how well they do that has been a real joy and fun to see.
So let's start with about 3 questions that just kind of give some background, big picture background on David Weekley Homes. Chris, I'm going to start with you. The kind of the David Weekley story, the origin story of the company at that high level. Let us hear about that.
Sure. So company was started in 1976 in Houston, Texas, by my father. It actually started after he worked for another home builder. And so he worked another home builder and got some experience. And his brother, Dick Weekley, is a big part of our origin story, was a financial backer, and David was a sweat equity. And so in the late 70s in Houston, they thought, why not start a home building company? And started up in Atascocita, Fun story there is Johnson Development is a big developer in Houston.
Mhm.
And so David bought his first lot from Johnson Development in 1976. Today, we're still buying lots from Johnson Development. So 70s was great. And then mid 80s, Houston went through a big economic downturn, oil bust, and company almost was insolvent, almost went bankrupt. And so the choice was, do we double down in Houston or do we grow? Ended up growing to Dallas and Austin at that time. And Dallas and Austin really saved the company. So that's what got us started, a kind of geographic expansion. So really through Texas, and then we made our way to Florida by working with Disney and Orlando in the mid '90s, and then kind of continued geographic expansion after that. But what's been great about the company is we have a lot of senior tenured leaders. I mean, our average tenure on a leadership team is in the mid 20 years range. I'll actually bring that down. Jay brings it down. We have a lot of senior great leaders. And so kind of feel like we're standing on the shoulders of giants that have really helped build a fantastic culture and great company that just love coming to work every day and working with great people.
That's always smart. You want to mix that old with the new. But if you lose that institutional memory and you forget what you don't know and what you learned, or at least you're in danger of doing those things. Jay, David Weekley is one of the bigger privates in the country. It's that weird thing. You're not a Wall Street. You don't have to answer to Wall Street, but you're a very large organization that has to, in many ways, act like a public. Tell us about how it is being a big private.
Well, there's some really great things about it. One of the areas that I think is most helpful for us is our ability to take a really long-term view and not be so concerned about the quarterly earnings, or even inside of a year. We can take a long view because the capital is held long-term, right? We have long-term owners. We'll talk about that, I'm sure, as we get into the conversation around how we think about that ownership structure, but it's very long dated. So we can think about decisions that we make, whether it's land, entry into markets, how we run the business, how we think about succession planning, leadership development. We can take a very long view of that, and we do. I would say that's one of the biggest strengths of being a large private. The other aspect I would mention about being a large private is I think we're big enough to matter. As you look at the consolidation in the space, whether it's around the building materials or some of the other acquisitions and large publics that are happening, there is benefit in scale, driving down costs, supplier relationships. But I think being big, we're big enough that we're able to get to where we need to be from a partnership standpoint on the supplier side. And that's an important part of the business. Ultimately, our ability to drive down costs and provide homes at reasonable prices are a direct corollary to what we're able to do on the sales side. So if we're not able to compete and lower cost and drive the right value on the supply chain side, that'll really inhibit our ability to be competitive long term. So scale does matter in the business, we believe, and believe what our focus and size help us.
I'll ask you a question about capital in just a few minutes, but one of the things about public builders is that they do have this access to capital and private builders do not. But your size allows you to do the other thing that public builders have an advantage, which is constrained cost through the scale that you're talking about.
Well, on the capital side, the capital turns over really rapidly. I mean, we turn our capital over a little over 2 times per year.
Okay.
So it's not as though we need to go to the capital markets, go to the equity markets and access capital that is going to be parked for 30 years.
Okay.
So that rejuvenating of the capital, recycling of the capital, we have plenty of access to capital. In fact, most of the time we're trying to find more opportunities than we are searching for capital. So it's a business that really doesn't need to be public because we don't see any constraint on our access to capital.
Okay. That's interesting. That does give you a pretty decided advantage over, again, the smaller privates don't have that. That's one of the things, because I hear it a lot. A lot of our clients, we have huge publics and we have big privates and we have very small privates on the builder side, and definitely the capital, the cost, those buy-downs are costing me a fortune, whatever it is one of the common complaints. Jay, before we get into the kind of looking backward and the growth story and the strategy of David Weekley Homes, I wanted to ask you about you have this program within the ownership of David Weekley have something called the Employee Stock Ownership Plan, ESOP. We all love acronyms. Tell us a little bit about that.
Yeah, I was talking about the long dated nature of how we view the capital and the company. And one of the great things about our structure is we're basically a third owned by the Weekley family.
Yeah.
A third is owned by we call them team members, employee base, our team members. Our team members own a third of the business. And then a third of everything we produce, we give it away through our foundation and through our giving. And that enables us to think about things again on a very long-term basis. Like we're trying to not only provide a real return on capital, and we are serious capitalists. We make no apology for being capitalists.
Yeah.
We're proud of that. At the same time, we care deeply about our team and securing their financial future, and we believe deeply that the reward that our team receives is a direct result of the financial results that they produce. And so we try to make a really strong link with them, understanding that what they do matters, how it drives the results of the business, and ensuring that they benefit and are rewarded deeply from the results that ultimately they produce for the company. And then we also care deeply about our community. So it's an opportunity for us to use capitalism to do greater good in the world. And we think it's great for our customers. We think that they oftentimes, as they start to get to know who we are really proud of owning a David Weekley home as a result of where that financial result will end up.
Yeah.
And for our team, I think it's deeply rewarding for our team who think about the things that they do every day. Yes, there is financial reward for them, and obviously they're proud of wearing the blue brand and what they do for the company. But there's also a very real sense in which they're helping the world and helping their community, because a third of everything they produce is given back.
Yeah, and a third is kind of theirs. That ownership stake is critical. It just changes the mentality. I think even if it's subconscious, I think it does.
I want to add to it, add a little context. So from a team member perspective, we do a lot to take care of our team. One of the things that we do is we have an 8% dollar for dollar 401k match. And so that's huge. I think that's industry leading. We're really proud of that. So we want to invest in our team. We want them to be here for the long term and have this be their last job. So we really modeled the ESOP program to match that as closely as we could. And so the goal is essentially to have a 2x retirement. And so we believe that people invest their lives with us. We want to provide them the financial wherewithal to retire when they want to. So it's a long-term thinking. It's a huge part of who we are. And the other piece is it allows our team to have true ownership of the company. Yeah. These aren't fake shares. It's not like some fake certificate. Yeah. These are real shares of the company. And they get a statement every year showing the appreciation of those shares. That's really exciting for our team that have been here since we rolled out that program, because those statements are starting to get bigger and bigger. So it's exciting and kind of long-term investment. And it's great to be able to get back to the team in that way.
Yeah. I don't do well with humidity, so I don't think I can move to Houston, but gosh, do you have any? No, just kidding.
We're in 19 markets, Dean.
I know.
We had 18 other cities you could move to. Don't tell John that, though.
Less humid. I tend to melt in extreme humidity. So let's talk about this, kind of the idea that several years ago, you guys thought, okay, we're a big builder. We're a big private builder. We're in a significant number of markets, but you wanted to get bigger and to grow. So let's just talk about, what was that, I guess, the original impetus? What was that turned on the light bulb internally and said, hey, we need, or we want, or here's why we're going to start to get bigger?
You want to take that, Chris?
Yeah, I'll take that. And then Jay, you add on. Well, first of all, one of the mantras at Weekley Homes is forever improving, right? Like we always want to improve. We always want to get better. We're always going to drive to new initiatives, new growth, new markets. And so we've had various growth goals along the way. So you could go back 20, 30 years in the company's history, and we always have a BHAG, one of those big, hairy, audacious goals out in front of us. And so right now our BHAG is called Expedition Evergreen. And we closed around 6,500 homes last year. And the goal is to get to 10,000 homes by 2030. And each market has a plan and a number they signed up for to get to that 10,000. And we're tracking well. And I say all that, I mean, growth is important for the relevancy part that Jay talked about before. We also believe, that our model works well, being private and thinking long-term. At the same time, we also want to grow to continue to invest in our team, have more team members, invest in our customers and in the community. And so it's that, one of the stats that I quote often and, is that 20 years ago, the public builders had 20% market share. Today, they have over 50% market share.
Yeah.
So we're a rapidly consolidating industry. Now that doesn't count all the Japanese homebuilder investment we've had
That's true.
over the last years too. And so between public homebuilder companies and Japanese companies, there's a lot of consolidation happening.
Yeah.
And so we have a huge opportunity with our unique culture and how we treat our team and customers to really, kind of stake our claim, if you will, in a market that is getting less and less crowded as years go by.
That's a good point. With Daiwa and Sekisui House, there are some other big privates out there that have a huge amount of capital. So part of it was kind of defensive, I guess, in nature. Is you've got to grow and adapt. Otherwise, this is a dangerous marketplace to be in. Is that fair to characterize it?
I think that's fair. I mean, I think there's a lot of positive things with growth, but yes, we also feel like the industry is consolidating. We want to be relevant. We want to matter. We want to have a big enough stake so we can be here long term. I mean, we're 49 years old. Next year will be our 50th anniversary, which is fantastic. But I kind of think that we're just getting started.
Jay, what was the, I guess, the strategy as you're growing? I know you've only been there a year, but you're on the board for 7 years. And Chris, tell me if this is a good question for you as well. But what was the overarching strategy? Okay, we want to diversify in terms of markets. We want to diversify in terms of buyer niches, maybe in terms of the housing product. Was there all those things involved as you try to pull off this growth strategy?
Yeah, all of those are involved. We're certainly open to going to new markets in addition to the markets that we're in currently. But as we think about our forward growth, as Chris was talking about Expedition Evergreen, that's focused on just the markets that we're already in. So we're not assuming that we go to new markets. We are assuming that in terms of the type of homes that we build or the product sets, that we are expecting some growth in some areas that we have maybe dabbled in the past, but have not been a meaningful portion of our build program. So we recently launched Imagination Homes this summer, which is our entry level product. We launched that into outside of Dallas. And we think there's a lot of opportunity there. That's a portion of the customer base that we have tried in a few areas of the country to serve, but not with a concerted effort like what we've made. So the launch of Imagination Homes, I think, opens up entry level homes for us in a new way, and believe that we can serve that customer in kind of the David Weekley way, and doing it a little bit differently than maybe some others. And so there's an opportunity for us to delight a whole nother customer set there.
Jay, can I ask a question about that? Because back when I was doing studies in Texas and Florida and places like that, I'd run into you guys all the time. And my perception of David Weekley was very decidedly kind of a move-up builder, a very high-quality builder. The Imagination Homes is still under, though, the David Weekley brand. Have you thought about sort of the brand, what that does to the David Weekley brand? Is that a concern at all?
Yeah, we launched it as a separate company, so it's under the Weekley family of companies, so to speak.
But it's branded as Imagination.
But it's branded as Imagination Homes and separately branded, and the team is separate that works for Imagination Homes. The other area we're continuing to grow in is we've been in Encore. That's our age qualified communities. We've been there for a while, but continuing to make concerted effort on that front. That's very similar to kind of our historical move up buyer, just age qualified. And then we're also doing some stuff around build to rent. So we've had some success at that. Frankly, with the rise in interest rates, it's been much more difficult to put those deals together. So we have not seen as much activity as we had hoped. But we're continuing to build that brand out and look forward to kind of opportunities in the future when the capital markets allow that.
When we talk in the next sort of section, if that's the right term, when we talk about looking forward, I'm going to ask you a quick question on age qualified as well as build to rent. Chris, have you guys ever thought about acquisitions? Was that on your artistic palette, the potential for M&A?
Sure. No, we have, and I'm going to get this number wrong. We've probably done 12 or 15 acquisitions over the company's history. The last one we did, though, was in Phoenix, and that was a number of years ago. So we're not up to speed in the practice today, so to speak. I mean, we get sent things all the time, but candidly, that's an area that we're looking at, trying to figure out what our long-term strategy is. We are ultra protective of our culture. We think we have something very special here, and so we just have to be extra thoughtful as we go out to the markets. At the same time, we recognize that there's a lot of other great private builders out there that really care about their legacy, care about their team members, care about what the future holds. And so that might bode well for us versus others that maybe are looking for the biggest check. Maybe it's a longer term relationship, culture, et cetera. And so what's nice is being a private company, we can be very creative on how those deals look like and how they structure it and earnouts and all those different things. And so so it's something we've talked a lot about. There's a lot going on right now. It's a busy time, but there's always an area that we can be more thoughtful there. So we're not haven't done anything recently, but it's definitely something that we're talking about actively.
Okay. Yeah.
Dean, you asked that question about acquisitions, and there have been a couple of questions, and we've talked a little bit about growth. And I think it's really important as an organization, and I think this is one of our distinctives of growth for what reason, right? Okay. I came from a very acquisitive company. One of the ways that we grew was acquisitions, and there can be real value in acquisitions, but you've got to be really thoughtful about why are you acquiring something. And so reasons that might make acquisitions attractive to us is things like getting and gaining scale in a particular market, where we feel like we're undersized in a particular market and we want to get much better. Maybe there's a builder who has a really good reputation and a solid brand in a market, and maybe we're really small and just haven't gotten there. So maybe there's some value in that. But there isn't a desire on our part of growth for growth's sake. Being, as we look at the list of wherever we fall, you kind of started with how large we were. Being a particular number on that list is not really our ambition. Our ambitions are more, as you think about our purpose of building dreams and enhancing lives, and building an evergreen company. We think more about sustainability than we do about, okay, we definitely want to be X number on the page. And so if in the acquisition space, if we can get to something that we think is, hey, this makes us more evergreen, this gives us scale and gives us a stronger supply chain, lowers our costs, enables us to serve customers better, enables us to serve our team better. Those are good reasons that I think we would pursue potential acquisitions. But we don't have aspirations to just acquire for the sake of getting bigger.
I personally it's almost like the anti-Silicon Valley model, where it's, move fast, break things, get scale, IPO, cash out. Who cares what happens? You never actually, you lost billions, but you made billions personally. So we're an evergreen company as well. John Burns is as well. So I definitely have a lot of sympathy for that kind of be smart, don't grow for the sake of growing, just be really good and excel and you'll grow.
Yeah. So Dean, John is a member of the group that we're a member of called the Tugboat Institute. Yep. And for those of you that don't know, feel free to look it up. It's a funny name, but a great company and institute. And it's all about companies staying private forever, staying evergreen, and that being a great business model versus the grow fast, break things, make some money, and then what happens?
Yeah.
The average S&P 500 company is on the S&P for 17 years. Right. We've been around for 49 years.
Okay. Isn't that weird? Wow.
Yeah. And so, Tugboat, I'm in a small group there. There are 6 companies that are over 100 years old, and 2 of the 6 are over 150 years old. And so when I say we're just getting started, I think we're doing a good thing.
Yeah.
I think it's, it's conscious capitalism, and we're doing the best we can, but taking care of our team, customers, and community. So, I'd love to continue to grow the business model and, as large as we can, and share that with the world, and see if there's other folks that are willing to give team members equity and give some back to the community as well.
Yeah. As you've grown, you mentioned that you have this big, hairy goal of 2030 of having 10,000 sales. Is that typically your timeline? How far, as you've grown, how far have you been looking out into the future? Typically 5 years, 10 years? Has it been consistent, or is it just you're kind of feeling it out?
Most of those plans have been kind of 5 to 7 years.
Okay.
Yeah. I think Chris and I have conversations that are much longer dated than 5 to 7 years. But in terms of the practical, the way we're thinking about the business, we tend to think about that in about those timeframes. Yeah.
And it's not quarter to quarter.
No.
I'm being a stereotype, I'm being unfair. Those public companies are thinking long term as well, of course. But it is different, I'm sure, on a day-to-day basis when you don't have the really near-term constraints to the degree they do in the public world. Were there any, or have there been any kind of constraints on where you might go, where you wouldn't go, what you would do, what you wouldn't do? You said you're now doing BTR, you're doing entry level, you're doing age qualified. Are there markets you won't look at, anything like that?
I would describe things more around where I went with the answer earlier around how we think about growth. I think there are some things that just don't fit us because they wouldn't be the right cultural fit. Ultimately, couldn't be the right team member experience for our folks. Maybe we think we couldn't be successful in our model in some particular market, but we don't have a list of absolutely will not go there. In part because if you have an evergreen model and we're trying to run the business, thinking about what does it look like 100 years from now or 200 years from now, the landscape changes. And so under any measure that you can come up with, if you go back and look at the demographics of the United States, they look very different today than they did in 1976. And so roll this forward to 2075, I would imagine the demographics look very different than what they do today. And
we'll be living on Mars or in space colony. I mean, let's be clear.
So taking a long view of evergreen means that everything is on the table. And then we need to be really thoughtful about some anchors, some stakes in the ground that put guardrails around the decisions that we make.
I'm just saying, David Weekley, Martian habitat. I'm just throwing that out there. Think about it. Consider it. You're welcome.
I think I'm too old to be an astronaut.
We all are. Are you thinking about major metrics? Is it jobs, population? When you are looking at markets, your current market, whether you want to expand or maybe a potential new market, are you following the classic, jobs and population? Are there other metrics you guys look at?
We look at John Burns data because it's perfect. It's never wrong. And we just follow whatever you guys tell us to do.
Wow.
Yeah. Shameless plug.
I believe you.
Listen, I mean, like with anything in life, I mean, you can rely on data, but you can also rely on it too much. And so I think it comes down to people, it comes down to relationships too. And so there's some markets that feel like Weekley Homes and our brand and some that don't. We also have, operational prowess in certain markets, right? So where we have strong operators, like we'll lean heavily there. It's strong returns and profiles, and also, I mean, developer relationships, right? I mean, we live and die by our developer relationships. Today, 2/3 of what we build on is 75% of what we build on is with developer partners versus about 25 to 30% self-developed. And so, and let me be clear, we're self-developing because we have to, right? It's just to continue with scale, just like all the other builders. So it all comes down to people and partnerships. I mean, the data in the markets we're in is good. And again, we're taking long-term views of it. But we really want to have those good partnerships in the markets that we're in to grow long-term.
I'm in California, so I think some people think I might have a California bias. I don't. I realize fully how incredibly difficult California makes it for home builders to build in. But I spoke with, 20 years ago with you guys about just like, it was kind of tell us about the California markets, because you're thinking about it a long, long time and you never did. What is it that kind of keeps you out of California besides the really obvious, I guess?
Well, there's a lot of markets there's a lot of markets in the US that we're not in today. And so I would say there's a lot of great things about operating in California, and maybe one day we'll be there. We just haven't chosen to be there so far. And there's a lot of great places in the United States that we're not currently building homes. So maybe one day.
Are there any kind of, as you've grown and as you've expanded, what's like the lesson learned, like the mistake you made and you realized, okay, let's not do that again. Let's learn from that.
I think there's a pretty good list that are around here that we would say some things that we've learned. One of the things for sure that we've learned is the entry into the new markets takes some time. It's not easy to enter a new market. It's not easy to get to profitability in a market. It's not the same as going into a new community and getting to profitability relatively quickly. So one of the lessons that we've learned is you've got to take a pretty long view in order to say, okay, we're going to go to this market. We realize it's going to be challenging for a period of time while we build a brand and get ourselves up to speed before we're going to see profitability. I think the other thing that we have seen in some of the markets that we've gone into is going in with the right partner, whether that's a developer partner or going in through a good acquisition with a brand, with experience, with some folks that know that market. can be really helpful
Yeah.
to building what would be our business in that market. So those are at least two of the lessons. As Chris
Yeah.
mentioned earlier, though, it's been quite a while since we entered new markets, and so we haven't done them because we haven't seen all the characteristics line up. So we haven't learned any lessons. I guess I would say in the recent history, because we really haven't expanded.
What moved you guys to move into the age qualified space? Was it the peer? I think it's about 10 years ago, I believe, with Encore. Was it just the demographics? You saw that gray wave coming and wanted to tap into that?
Yeah, so I'll take that one. So yes, the demographics, gray wave. At the same time, I mean, that demographic is incredibly demanding and exacting, right? Like,
Oh man, oh yeah,
they've lived in a bunch of different homes over their lives, and oftentimes we hear, this is my last home; it needs to be perfect.
yeah,
And so it's a tough demographic to serve. At the same time, it's incredibly rewarding. I mean, it is so fun to go build these communities, because it's almost like the active adults. I mean, they're out in their driveways and sharing cocktails and pickleball. I mean, it's incredibly active.
and cocktails and more cocktails,
Right.
and wine.
Probably some of the most social folks that I've seen. So it's not an easy business, but it's incredibly rewarding. The buying process is long. That said, once you have a buyer, like, they're invested in you, they're invested in the community, they want their friends to come by, et cetera. And so it was a great wave, but it's also been a great way for us to partner with developers. We've done a lot of, I'll call them smaller active adults. Now that small might be 200 to 400 units homes within a master plan. And so what happens is, the grandparents will chase the babies, right? The grandbaby chasers. And so their kids will come by from us in the community, and then we'll have a active adult offering down the street where they can come by and be in the same community and go, pick up kids after school and all that sort of stuff. So it's been a great business for us. We continue to want to grow that and grow it appropriately, with developer partners and on our own if need be. And so, but we're just excited to continue to push that around the U.S.
Let's move into the kind of go forward then, and let's stay with active adult for a minute. I think you just answered my question a little bit, but I was going to ask you, in terms of community size, is there that ideal community size that you're looking for in terms of number of units? And is the old, the thousands and thousands of unit kind of a model, the villages in Florida notwithstanding, kind of the past in age qualified specifically?
Yeah, so I'll take that. I don't know that it's the past, right? I mean, you think about golf course communities and huge communities. I think there's a place for that. Candidly speaking, I don't think Weekley Homes is going to go buy a multi-thousand acre, multi-thousand home community like that tomorrow. Yeah. So I think for us, our business model so far has been to create these boutique communities. So you don't have the huge cruise ship, so to speak, with the 7 activity directors and 17 events a day. Rather, you have a more a smaller scale, still large scale, but more walkable community where you get to know your neighbors. It just feels maybe a little bit more special and unique than being part of that big. Again, nothing against the big. It's just a different lifestyle, different level of activity. We still have plenty to do, but it's not, all these activities all the time. So it's been the right approach for us. I think it fits our brand well. And from an operational standpoint, we can get in and get out in a fair amount of years too, versus being anchored for 10 or 15 years.
But even at that size, it's important, I'm assuming, to tell me if it's not, to have that amenitized environment. You have the pickleball, you have the clubhouse, the fitness center.
We have all that. And I'm smiling because managing the HOAs of active adult communities are very fun and lively. There's lots of opinions there.
It sounds fun.
Where you put the pickleball courts and how loud they are, and if the lights stay on past 9 o'clock or if they go out before 9 o'clock, and all that. At the same time, again, it's incredibly rewarding when we have a great community and people are bought in. There's nothing like it. And that community feels great, and sales continue to come, and it works, and it satisfies a special need for a lot of people that want that social aspect and want kind of a special jewel box home at a certain price point. So
speaking of pickleball, now that the kids are playing pickleball, it's become popular among all age groups. Shouldn't you counter that with amenitizing something like the retirees can steal something from the young folks? Like, I'm thinking laser tag or dodgeball. I'm just throwing that out there as potential in your amenity package. Is that a go?
we'll have to figure that out with HOA insurance, et cetera. I'm not sure. Maybe we'll bring some, scooters or skateboards or something. Well, yeah, we'll let the old folks teach the young kids something.
I mean, what's the worst that can happen in Dallas, Bob?
We've had some company events where there's been some dodgeball injuries. So I'm not gonna.
Wow. I feel like I touched a nerve there. Let's switch over. Jay, let's talk about built to rent. So that's fairly new from you. The capital markets are there. What was it then? Same kind of question as earlier. That was the impetus for, hey, let's move into the built to rent space.
I think the frame through which we think about delighting people drives us to that business of the rental community. I think people oftentimes would think about whether it's a rental car or a rental home as not being necessarily a place of excellence.
Mm-hmm.
And we saw it as an opportunity. Certainly we can get great returns there, but we also saw it as an opportunity to serve people who were not necessarily ready to buy their first home, but were going to be in a rental home. And we could delight people with a really incredible experience, creating great spaces. And we thought we could differentiate ourselves in part because of the way that we think about choice. So a lot of people who've entered that build to rent space, they've really done it as like, okay, we're going to build this model in this way. And the capital partners who would come along and own those homes were basically buying whatever the home builder wanted. And we've really flipped that model to, okay, we'll actually work with whoever the capital partner is and whoever's going to be the long-term owner to build something that is easy to care for, easy to operate, gives them an ability to give some impact on, okay, what do we want this to look like? What are the elements of these homes that we would like to be there? What's going to be marketable? So I think we changed the model a little bit and do it a little differently than a lot of the other home builders. It's not a what's left over model. It's an intentional, we're going to go build these homes and we're going to build them for a partner that brings capital and is going to be a long-term owner of the homes.
Is capital starting to unfreeze at all in that part of the world?
Not really.
No.
Not meaningfully. There are certainly some deals that are getting done in some markets on a one-off basis, but the return expectations of the equity and where the cost of the leverage is just, they're too high to really put together a good deal in the market. So if you find like the magic of the right land buy and the right price and the right market, like, yes, we are doing some and we'll do several hundred this year, build to rent, but not at the scale that we would hope to do.
It's just a great product. I mean, we've had people on the show who've talked about this in next issue, and I don't want to make it sound overly altruistic, but what build to rent does, and you kind of hinted at it just a second ago, is allow folks that couldn't live in some really high quality neighborhoods to live in some really high quality neighborhoods. Has that been, just part of your thought process as well?
We think about serving our team first, our customers second, and our community third. And I would put that until we were in the build to rent, those folks were in our community, but we weren't able to serve them. And we figured out a way to take some of the community and move them into the customer realm. And it's also great. I mean, if they have a great experience, at some point we would assume many of those folks will move from being a renter to being an owner. And when they do, if we've created a great experience for them, then hopefully we're at the top of their list of people they want to come talk to about where they're going to own a home.
BTR just makes so much sense. It's one of those things like, why didn't that happen at this scale long time, many years before it did happen? So we've had a lot of BTR folks on the show, and we'll have them on again, but I'm glad to get you guys. Are you guys in expansion mode on BTR? Is that part of that 10,000 units by 2030? Is that considered?
It is.
Okay.
It is. Yeah. I think long term, we expect that our traditional product, our move up, is probably going to be 60 to 70% of the overall company. And these other areas that we've talked about, the Encore, Imagination Homes, at least in the 5 years, 7 year time frame, all those products are probably 30 to 40% of the overall company.
Okay. So looking forward overall, I know you have that big, hairy, audacious goal by 2030. Have you pulled back in any sense at all, given the kind of the market hiccups this year and the likelihood that we're going to have a challenged market into next year? Does that change your thought process in terms of being in growth mode at all?
It really hasn't. It has changed the way we think about what our return expectations are. And I think we've been more selective as to where we've placed our capital. But the land transactions that we do today, those won't result in homes that we're going to be building for at least two,
Yeah.
3, 4 years, in some cases, even longer than that. In some markets, it could be up to 5 years. So if you could tell me, Dean, what the market will look like 3 years from now, then maybe we would adjust kind of our land plans today. But we
Yeah.
don't have a crystal ball, so they have not. We've continued to look for great opportunities. We've found some opportunities that maybe we would have not had as many choices on if the market was really red hot. So we've been, I think, more selective
Okay.
and more thoughtful around where we've placed that capital, and probably have had some opportunities, more opportunities maybe than if the market were really hot.
Is there anything you're looking at in your at least near-term crystal ball that might change this outlook? Something economic, anything like that?
We've had a what I would describe as a pretty good year. Our expectations going into the year was that this would be a down year from what we saw in 2024. That's proved to be the case, but we've exceeded our expectation for net income. We've actually exceeded that expectation for
Huh.
the calendar year to date. I really give a lot of credit to our team, because the amount of foot traffic that we've seen and the absolute sales at the top line have been down
Yeah.
year over year considerably.
Mhm.
But our team has done a really good job of being thoughtful around the costs and have figured out a way to run a profitable business in the current environment. And there isn't anything that we have seen that I would point to and say we're really concerned about being in the home building business. There's been a lot of volatility, kind of market to market. You've seen that in your own data,
Mhm.
in your own research, and it's not predictable at all. So we may go through a couple of really good weeks in a market, and then suddenly it falls off, and then it comes back as quickly as it disappeared. And we've seen that kind of across the country. So that would be one thing that I would just say of, like, we've seen some ups and downs without feeling like, okay, this is about to really crater on us or the bottom's about to fall out. The other thing that's interesting is whether it's website traffic or the folks that we do see coming through our homes and the interactions that we have with our customers, people are serious about buying homes. Like,
Mhm.
it's not as though there isn't anybody thinking about it. So it may be that the analogy that I've used with our team is, I believe we're compressing a spring.
Mm.
Um, there is a need for new homes. There's a need for housing a lot of people in new structures. That's a reality in the market, and the high interest rates have kept people out of
Yeah.
going and doing that. But they are still looking and trying to make decisions about, where do they want to live, what community
Yeah.
do they want to live in, what kind of home do they want, and ultimately that sort of compressed demand, that spring will release at some point, and I can't tell you whether it's the end of this year or into next year, or what exactly the mortgage rate has to get to.
Yeah.
But I really do believe that the pressure on the spring is going to come off of it. And when it does, I think we and all the other home builders are going to be incredibly busy, because I think demand is sort of stacking up in the corner, and we'll see a real demand drive, and this will spring back the other way.
So almost the opposite of when there's been several times throughout the last decade plus where we seem to have been pulling demand a little forward when rates took a dip and some demand forward, and that kind of balanced out the later in the year or the next year. So you see almost the opposite of that.
I think that's what we're in right now. Yeah.
Yeah, yeah, Dean. Let me add a couple of things to that, and I agree with everything Jay said. I mean, it's interesting. July, we had our all-time record website visits in the company's history, and then from June to July, we've actually seen an increase in sales, an increase in builder sentiment.
Yeah.
And so it's typically right. You have the spring selling season, and things kind of fall off towards the end of the year. So that was really exciting. The other piece I would say, just put things in perspective. And Lad Fargo, our awesome COO, said this a number of months ago. He said, we're back to normal market, right? This feels like 2019. Every market, there's some deals are doing well, some that aren't. You got to kind of work every home contract to make a deal. During COVID, I think us as homebuilders, we got a little spoiled as kind of being a seller's market, right? Buyers were coming to us, we were taking orders, et cetera. Now we got to work a little bit harder. So it's kind of back to the basics, and the team's done a great job. pivoting there, but it feels a little bit more like a normal market. I just think it's been 5 years since we felt that.
Yeah.
So,
Yeah.
so we're kind of going back to the basics with the team and working on every deal. And I think every home builder out there is doing that. But the traffic signs are encouraging. I love that vision of a spring compressing. I agree with Jay on that 100%.
It's funny you say that because people, I don't know, if your career in housing was in the 50s and 60s and 70s and into the 80s and into the 90s even, it's so different. I mean, we had the crazy days of the early to mid 2000s, followed by the Great Recession, followed by a incredible historically low interest mortgage rates, followed by COVID, and now followed by this sudden increase in mortgage. All of those things in isolation seem like almost like black swan events. We've had them event after event after event over the last 20 plus years or so. It's really, it's crazy times. Are you seeing right now, are you seeing the weaknesses though we expect to see, like, Florida and kind of the Sun Belt stuff? And are you seeing strength in some of those, quieter markets? I think you're in Minneapolis, you're in Indianapolis, the Midwest seems like it's a little more, steady as she goes. Are you experiencing that within your sales and environment?
Thematically, I think if we were to sit here and kind of go market by market, week by week, you'd be hard pressed to make any generalizations about the Sun Belt or the Midwest or the West. There has not been any markets that we would have looked at, with a couple of exceptions, that we would have looked at and said, this has just been an awful year. They've had spurts of good growth and good activity, and so yeah, our Midwest markets have done well. Sun Belt's done well. Texas has done well at points, and it has not been a consistent thing or a theme that you can point to and just say we've really struggled in this part of the country, but this other part of the country has done great. Carried us.
That's interesting because overall, so we have seen year-over-year price depreciation at a higher level in places like that, some of those high-flying markets. So I was going to ask you, I mean, I think I still will, though, is that given what's happening to other builders there and what's happening to prices in some of those, again, higher-flying markets, has that made you at all cautious about them, or your Floridas, your Carolinas, or do you see that that's just a blip? Structurally, those places are really sound.
The places where you would make adjustments would be, okay, how much land do we want to own and how aggressive are we going to be? And to my point earlier around taking the longer term view, if we know where the market was going to be 3 to 5 years from now, certainly we could adjust that.
Yeah.
But in all likelihood, I think whatever this turns out to be, the market likely will be in a very different place. It could be much worse or it could be far better than what it is today in 3 to 5 years. So we're focused on continuing to invest in the markets that we're in because we made the affirmative decision to be in those markets, and we think there's a lot of opportunity long term. And ultimately, we'll let the margins will fall where they may in those markets that we're continuing to invest in. And we have not taken our foot off the gas, but we've been more selective in how we've evaluated land opportunities that we're going to make investments in future communities.
Speaking of the future, I ask this of every builder who comes on the show, is that two parts. One, have rate buy downs been a big part, a key tactic for you folks to make sales? And two, are they just here kind of indefinitely? Are they here to, maybe not forever, but for the long haul?
We are using those in order to drive volume and to get volume, just like all the other home builders are doing. So yes, we are using it as a tool. Will it be here forever? I doubt it. I'm sure there will be periods of time where the market goes the other direction, and rates get to a point where that's not a necessary component, and so it'll come away. I think all of the home builders have gotten, as an industry, we've gotten much more towards a production model. And I don't mean that in terms of a production home. I just mean it in terms of a production model where they think about ensuring that the assembly line and the supply chain keeps moving and going. In order to do that, what has to move is the revenue component of that and the price of the homes in order to keep a certain volume of the home flowing. And one of the ways to do that is through rate buy downs and other financial incentives in order to keep sales going. So I would suspect that what we'll see is in periods of time where that's lighter, than the industry will have those incentives in place. But again, I would put this in context, right? And I feel in some ways probably for our having lived previously in the public company world that they're making good business decisions as I think we are. And I mentioned this earlier, we're having a year better at the bottom
Yeah.
line than what we expected. So are we using incentives? Absolutely.
Yeah.
Are we using incentives to the place where we're like, oh, this business isn't fun? No, not at all. We're able to use incentives in a smart way,
Okay.
and we're still getting a good return on our capital and delivering a great return for our team long term. And that's a good dynamic to be in. And as Chris said, yeah, it's a little tougher. But maybe back to more of a normal year. That's okay. You can work hard for good returns.
Yeah. I'm a couple more questions, then we'll wrap up. But I am going to put you a little bit on the spot. I won't ask you 3 years from now, but a year from now, where do you see the housing market being? Just say relative to right now, relative to current conditions, a little bit better, a little bit the same, a little bit worse than a year from now or so.
Yeah, I'll take that. First of all, I think in this business, you always have to be optimistic, right? We're always looking forward. I mean, it's a tough business. There are cycles. And so, I think interest rates will be down. I think we will have a spring selling season. It was kind of muted this year. And so my hope thinking about this a year from now is that we have a great spring selling season. And, it's an overall steady market. I don't think it's going to be rainbows and unicorns, and I don't think it's going to be horrible. Candidly, I think a year from now, people will be more used to interest rates, right?
Yeah.
If you look at the history of interest rates, 6.5% interest rate, 6.75% is a good interest rate over time, right? We all kind of got spoiled with these numbers in the 2s and 3s. And so kind of the market's living through that. That memory is strong. At the same time, like families need, if they're going to add a kid or a life event happens, or they get married or divorced or grandparents come live with them, et cetera. I mean, that's going to force moves within the US that will kind of unlock the market. We're kind of in this strange era where a lot of the resale markets has been locked up, but it's kind of starting to release now.
Yeah,
so
it is.
Again, like you said, almost black swan events that haven't happened before. So I think we'll just be in a normal market. I'm really confident that our team can outperform and we can continue to kind of push company's legacy forward.
Lack of resale supply has been a huge boon to new home builders for a few years now. Are you a little bit nervous about resale supply coming back as it has in most markets?
Well, we say resale, and I'll say this jokingly. It's a used home, Dean. So we prefer new homes, right? We want to have no toenails in the carpet and all that
like
sort of
that.
stuff.
It's pre-owned,
so,
Chris. Thank you.
Yeah. So we no, I mean, I think it'll unlock, and our team will figure it out, and the market will steady itself. At the end of the day, the way that we're building homes today, the energy efficiency, structural integrity, the materials, et cetera. It's a premium product, and so it's going to be cost a little bit more, but appropriately so. I mean, we have a great product, well designed, et cetera. So I'm not that worried about it.
What excites you the most going forward in your business? That you've said 100 things. I'm going to ask you to do maybe one each, Jay and Chris.
Yeah. So for me, it'd just be growing our team, the people, the culture, and growing our impact with customers and community. I mean, so it's more of the same. And I say that like the same isn't bad, that the same is great. I mean, I love coming to work here. We have a great team. And so I'd love to be able to grow our impact to people. And those people are our team, customers, and the community around us. So I mean, that's what gets me excited is to keep on growing. I'm also competitive, right? It's kind of fun to go compete against the big guys, kind of a David and Goliath story, if you will. So I want to go compete also and hopefully win.
You're a bigger David, but I get what you mean. How about you, Jay?
I look at where technology is going, and I think there is an opportunity both in terms of the way we run the business and the way we interact with our customers to really change both our team member experience of doing the job day to day and the customer experience of embracing technology. That could be a real difference. Like, it's striking to me, coming from a very different industry in the telecom space, it's striking the kind of customer experience and the focus on that customer experience that comes out of that world. For someone spending $1,000 on a device and what they experience in that purchase. And then to come here, our average home sale is a little under $600,000, and to see the kind of customer experience that's expected among home buyers, and there's a big disconnect there. And so I think we have an opportunity to create a really unique customer experience, and that experience will also translate to our team members. Where 5 years, 10 years from now, the process of both buying a home and the interaction that occurs, as well as what it's like to work in this business, I think will be a very different thing. And I think we could make it look much more like aligned in terms of what that experience feels like. Of someone spending $600,000, they get an extraordinary experience rather than something that doesn't feel so extraordinary relative to other products in the world. So I think that opportunity and the leverage of the scale of the purchase relative to the experience, I think there's something there for us, and I think we're going to capture that, and I think it'll be wind in our sails.
Yeah, it is funny how home building really has changed more in the last 5 or 6 years than it probably did in the previous decades. And maybe it was, the impetus may have been COVID, but and technology, but it really is changing, and it'll be interesting to see how you guys change it over the next few years as well. Jay, Chris, thank you guys so much for coming on. This has been great. This is exactly what I was hoping for. You guys nailed it. Thank you.
Thank you for having us.
Thank you, Dean. We appreciate it.
Absolutely. Of course. This is Dean Worley with the New Home Insights podcast. Thanks for listening. We'll see you again in a couple of weeks. Since you forgot to hit the stop button, I'm going to take a second to tell you about our weekly building market intelligence newsletter. Over 40,000 smart folks get these timely takes on the housing market in their inbox every week, and you can too by heading to jbreg.com/subscribe and signing up.